Most people expect rates to fall fast, but the data suggests it's higher for longer. In 7 minutes, I'll show you the 4 drivers, who it affects, and a simple playbook you can use this quarter. Since late 2022, central banks fought inflation with rapid hikes, pushing the federal funds rate in the US to its highest since early 2005, just under 6%. Inflation has cooled significantly from its peak, but not evenly. While goods inflation collapsed as supply chains normalized, services inflation stayed stubbornly high as rent, insurance, and healthcare categories moved very slowly. These make up around 2/3 of core services and overall CPI. Meanwhile, wages have proven resilient too. Headline numbers dipped in recent months, but that was mainly due to the base effects from last year's outsized gains. When those fall out of the calculation, underlying wage pressures stay high. And housing, well, that's been a laggard. Mortgage rates have only recently cracked 6%, making affordability worse than during the pandemic, all while rental markets are still grappling with measurement lags. So the disinflation is far from over. In fact, we could be in for more surprises given inflation expectations are still uncomfortably high. Markets currently price in 2.25% cuts by year end. But we think they're getting the wrong signals because inflation dynamics have changed. Here are 4 reasons why rates may stay higher for longer. Number 1, core services are sticky. We already covered this, so let's move on. Number 2, labor. Despite cooling, the labor market remains tight. And that's for a few reasons. First, participation in the US and Europe has recovered unevenly. Around 3 million Americans left the workforce entirely, and that's unlikely to reverse fast. Meanwhile, Eurozone participation is actually below pre-pandemic levels. That means less supply to meet demand. Second, productivity gains are proving elusive. In the US, output per hour barely budged from Q1 2022. Companies can't do much about the first issue, so they're addressing the second by hiring carefully and relying on automation instead. Just look at how many robots companies are buying. So wage pressure persists. Growth is to 4.4% year over year. Remember, that's above the 2% target. And if we go by our measure, which includes benefits, wages are growing twice as fast as they need to. And if that doesn't change, central banks won't cut aggressively. Reason number 3, fiscal impulse. Policy support didn't vanish. Infrastructure outlays and incentives created demand pockets. Some $1.2 trillion of the US stimulus spending remains, and Europe is just getting started with theirs. This props up activity and reduces the room for aggressive cuts. And finally, reason number 4, housing. Shelter lags. New leases filter slowly into indexes. Owner's equivalent rent, which makes up around 1/3 of core CPI, keeps core elevated even as spot rents cool. It's the same story in Europe. The OER is still rising, so the all-clear signal could come later than expected. Those are the reasons. Now let's cover who it affects and a simple playbook you can use. So who does this affect? Well, 5 groups really. First, borrowers rolling variable debt face higher costs. Think credit cards, adjustable rate mortgages, and floating rate notes. Second, long duration assets suffer when rates rise. They remain sensitive until maturity. That includes bonds, infrastructure, and even autos. Third, savers benefit from higher yields, but real returns depend on inflation. Fourth, small businesses see tighter credit. Lenders rely on longer-term funding, so they feel every rate hike. Recent surveys point to lending standards staying tight. Finally, housing transactions. With the 30-year fixed approaching 7%, buyers are priced out, forcing sellers to lower asking prices and cutting corporate profits. So that's the scorecard. Let's wrap up with the playbook. Step number 1, shorten duration. We think rates will stay elevated, so it's best to avoid assets with big price swings. Lock in low rates where possible, especially if you're rate sensitive. Step number 2, stagger maturities. Avoid a single date cliff. It makes refinancing or rollover riskier. Step number 3, stress test cash flow at plus 150 basis points. You should know how much your income or savings can withstand an adverse scenario. Step number 4, prioritize pricing power. Equities are forward-looking, so focus on companies that can pass on higher input costs. That includes energy, materials, and industrials. And step number 5, hold dry powder for dislocations. Markets are inefficient, especially in the short term. Cash or underexposed portfolios allow you to profit from mistakes. That's our playbook. In 2025, the global economy faces headwinds from higher rates, tighter credit, and slowing growth. Central banks were forced to pause tightening as the economy wobbled. But with inflation proving stickier than expected, they've had to keep policies tighter for longer. Some countries like Canada have already started hiking again. Others like Australia, Brazil, and Japan have signaled their intent to keep policy firm. And the US Fed is no different. Their new dot plot shows rates staying higher than previously anticipated and only easing in 2024 and 2025. Markets are only now starting to price in this reality. Bond yields have risen sharply across the curve and the dollar rebounded against the euro. It's still lagging behind the pound and yen though. So what does this mean for investors? To answer that, we need to talk about 3 factors. First, the magnitude of the rate increases. Second, the pace of the hikes. And third, the level of rates once they peak. Let's start with the magnitude. How big are these rate increases? Well, here's the thing. Every central bank operates differently. Take the European Central Bank. They lifted their deposit rate by 25 BPs in July and are expected to hike again next week. That's in contrast to the Fed, which increased by 75 BPs in June and then by another 25 BPs in July. As you can see, the ECB started earlier, but the Fed went straight for a bigger bite. Next, the pace of hikes. When central banks hike fast, it puts downward downward pressure on economic activity. The faster they raise rates, the quicker companies and consumers feel the pinch. Look at the US, for example. The Fed hiked by 25 BPS in March and then by 50 BPS in May, pushing the economy to the brink. GDP shrank 1.6% in Q1. Then they hiked by 75 BPs in June and July, causing spending to slow dramatically. And finally, the level of rates once they peak. That's important because it affects borrowing costs for extended periods. Higher terminal rates mean higher mortgage rates, for example, which directly impact the housing market. So let's put these factors together and see what happens. Here's the thing. Rate hikes affect everyone, but some are more vulnerable than others. For example, emerging markets. When central banks in developed economies tighten, capital flows to safer assets. That leaves developing countries scrambling for dollars. The stronger the Fed gets, the greater the impact. Take Turkey. Their central bank kept interest rates low to support growth, but that came at a cost. The lira tumbled against the dollar and inflation spiked. Investors also pulled money out of the country, leaving it with fewer reserves. The result, slower growth and a current account deficit. What about China? Well, they face a similar challenge. The yuan is down 10% since early 2022 and inflation is stubbornly high. Recently, Beijing lowered lending rates to boost growth. But this isn't sustainable. Analysts predict Chinese inflation will stay above 3% through 2025. That means Beijing must choose between growth and inflation, which brings us to our favorite trade, Treasury Inflation Protected Securities, or TIPS. They offer a real return with inflation protection. Plus, they're liquid and relatively safe. In other words, they're the perfect hedge against sticky inflation. But TIPS aren't the only beneficiaries. We think there are two more trades worth considering. One is floating rate debt. It offers a predictable payment tied to a benchmark rate. As inflation rises, so does the payment. That makes it ideal for homeowners, businesses, or even governments with variable rate debt. The other trade is shorter duration assets. When central banks tighten, longer bonds suffer most. After all, you're locking in a low yield for years, so consider shortening duration to limit downside risk. Now, we haven't shared specifics so far. Let's fix that. Tips are great, but which ones? We like 5 to 10 year maturities. They balance inflation protection with liquidity. Floating rate notes are another option. We recommend those issued by governments or agencies. That's because they tend to be safer and more liquid. Finally, for shortening duration, we suggest focusing on government bonds. They're typically less volatile and more liquid than corporates. So there you have it, 3 trades to consider amid sticky inflation. And if you want 7-minute macro breakdowns with simple playbooks every week, subscribe to stay informed, and thank you for watching.